Bitcoin has stepped directly into Wall Street's collateral stack, and this bull run is already operating under a different rulebook than the ones most people remember from past cycles. While everyone online argues about green candles and red candles and whether the top is in, the biggest banks in America have quietly begun issuing credit against Bitcoin. US regulators just launched a pilot that allows Bitcoin to be used as collateral in derivative markets, and high net worth clients can now buy Bitcoin straight from their private banker. In this video, I want to show you how Bitcoin is getting wired into the very core of the traditional system at the exact moment a new liquidity phase is forming across equities, AI, and global macro. We're going to connect the dots between bank credit, the CFTC's new collateral rules, on-chain supply, and what the Federal Reserve is preparing to do as we move into 2026. By the end of this video, you'll understand why the foundations beneath this bull market look nothing like the old having old story, which is what it is. And you'll have a clearer framework for the environment Bitcoin is actually already trading in today. All right, let's begin with where Bitcoin stands right now. Short-term volatility has picked up. Earlier today, Bitcoin briefly dipped under $90,000, and sentiment across social feeds flipped negative almost instantly. But at the time of recording this video today, Bitcoin is trading around $94,000. When you zoom out to the weekly chart, the picture becomes more grounded. Bitcoin remains right on the trend line that's guided the entire move from the lows. As long as the weekly close holds that line, the primary uptrend stays intact. So far, each pullback has created a higher low, not a lower one. Think of it like a staircase. The steps wobble, but they continue upward. What matters is whether the next step falls below the last one. And so far, we don't have that. The price looks noisy in the short term, while the larger structure still rises. Now add the capitulation signals. The Bitcoin market capitulation oscillator has spiked to levels historically associated with cycle bottoms. Those moments when weaker hands finally exit and stronger hands quietly absorb their coins. On-chain data reinforces this too. Over the past year, roughly 403,000 Bitcoin have left exchanges. Balances dropped from around 8.1% of supply to just above 6%. So in plain English, fewer coins now sit on exchanges ready to be market sold. More sit in long-term wallets and corporate treasuries. That shrinks the pool that can flood the market during panic moves. So when you zoom out, three things show up at once. On the one hand, sharp short-term fear. On another, a rising staircase of higher lows. And on the third, supply draining from the places where people sell quickly. That combination tells us something important. The surface is chaotic, while the foundation still holds. With that picture in mind, let's zoom out to the broader market and the shift happening in risk appetite. The total put-call ratio in US equities just fell to around 0.7, which is one of the lowest readings in 4 years. More traders are positioned for upside than downside. At extremes, this can reflect overconfidence, but here it mainly signals a strong risk-on attitude. And Tony Pasquariello, Goldman Sachs global head of hedge fund coverage, described his stance as responsibly bullish. I love this. It almost seems like an oxymoron, but it's perfect. For some context, this is the person who speaks to the largest hedge funds in the world every day. So when he leans bullish, it reveals how major institutional desks are feeling and positioning themselves beneath what is obvious. History also gives us a striking signal. Carson Investment Research analyzed every period when the Federal Reserve cut interest rates while the S&P 500 was within 2% of all-time high. 1 year later, the S&P finished higher 20 times out of 20. That's a 100% hit rate across different decades and different Fed chairs. Rate cuts near highs often become fuel for risk assets because liquidity enters a market that is already structurally strong. Now add tomorrow's setup. Jeremy Siegel, chief economist at WisdomTree, expects a 25 basis point cut paired with a hawkish tone and visible dissent inside the Federal Reserve. That kind of mixed signals or mixed message usually creates short-term volatility. Some officials emphasize caution, while others push for easing. Markets latch onto every word. But over the medium term, cuts delivered near record highs typically point to an easier policy path. And that's where that 20 for 20 statistic matters. Then there's the Russell 2000, the small cap index of roughly 2,000 US companies. Large caps can grind higher even in tight financial conditions, while small caps usually need easier credit and more liquidity to move. Swissblock highlighted that Russell is breaking out of a long range again, mirroring the setup before Bitcoin rallied nearly 380% in the previous cycle. So you have option traders leaning bullish, a Fed Reserve approaching a cutting cycle, and small caps waking up, and one of Goldman's most plugged-in leaders expressing confident optimism. That's the background music playing while the internet focuses on every Bitcoin candle. Now, let's shift to the second engine driving new liquidity into the system, and that is the AI boom. For months, Nvidia told markets to expect almost zero chip sales to China due to US export restrictions on advanced AI hardware. One of the company's largest demand centers looked effectively cut off, and traders began treating China as a dead market for Nvidia's top-tier chips. Then the narrative shifted, as it always does, all as new China-safe chip classifications and regulatory workarounds emerged. Demand from China began returning. Nvidia added roughly $200 billion in market cap around this pivot, a reflection of investors realizing that a major part of its China business was coming back online. From a market perspective, that looked like a green light. The AI chip boom would still include China. Then the political layer kicked in. Donald Trump says the US will take 25% of revenue from Nvidia's H200 chips sold in China. A little steep, in my opinion. Meanwhile, reporting from China indicates that access to those same chips may require an approval process where buyers must explain why domestic suppliers cannot meet their needs. How this unfolds is still uncertain, and I'll be following it closely and reporting here to you on my channel. The net effect is clear. Nvidia can sell into China again, supporting the global AI boom. And every sale now flows through two governments that want oversight and a share of the revenue. This is why AI chips behave more like a strategic resource at this point than a consumer product, and why so much public and private capital keeps pouring into the sector. Think back to the internet boom. Telecom firms overbuilt fiber networks. Tech companies raised massive capital, and those dollars eventually spilled into stocks, housing, and financial assets of every kind. The AI race can play a similar role, and we're already seeing this happen. It drives new money into the system through chip makers, cloud providers, and infrastructure. Some of that capital eventually seeks returns on risk assets. Bitcoin sits at the edge of that river. Liquidity, global, and always open. Now that we've connected macro and AI as major liquidity engines, let's shift to the regulatory changes happening directly around Bitcoin itself. The U.S. Commodities Future Trading Commission, the CFTC, just launched a digital assets pilot program allowing certain derivative markets to use Bitcoin, Ethereum, and USDC as tokenized collateral. They paired this with updated guidance explaining how tokenized collateral works and removed older rules that previously blocked this innovation. In simple terms, major futures and options players can now post Bitcoin or stablecoins as margin. That shifts Bitcoin from a speculative asset, though we know it's more than that, but generally speaking, in terms of trading, that's what it is, into accepted collateral inside regulated markets. Bitcoin begins joining the same collateral ecosystem that currently includes treasuries and blue chip equities. The SEC is also signaling a different tone. On December 15th, the Commission will host a roundtable on financial surveillance and privacy with teams from Zcash, Starkware, and others. I just want to pause here a second because this is critical, and I will be following this very closely and reporting back to you on this meeting as well, because just from a high level, to combine financial surveillance with privacy with tokens that are designed to maintain our privacy is alarming, but let's let things unfold before we panic. And let's hope that despite their working together, privacy is maintained within these privacy tokens. If not, I'm sure other private and privacy tokens will rise. Anyway, what we see is that the US government will be sitting down with zero knowledge and privacy researchers to discuss how these technologies integrate with real regulation. Once again, it doesn't sound like the best combination and sounds like a proper oxymoron, but we have to see how things play out. Next, outside, the US stablecoin infrastructure is upgrading. Circle recently secured a financial services permission license from Abu Dhabi's SFRA, allowing it to operate as a regulated money service provider inside the Abu Dhabi global markets. In practice, this gives USDC clear legal standing in one of the most forward-thinking financial hubs in the world, and it makes it easier for institutions there to move dollars on-chain. Taken together, these developments show something important. Regulators debate crypto's place, but at the same time, they are actively building rulebooks, collateral frameworks, and international payment structures around it. And that brings us to the next stage. That is how traditional banks themselves are treating Bitcoin. Last week, we saw Michael Saylor highlighted which major US banks now issue credit-backed Bitcoin. The list included Citi, JP Morgan, Wells Fargo, BNY Mellon, Charles Schwab, and Bank of America. When institutions of this scale lend against Bitcoin, their risk teams have already built legal frameworks, pricing engines, and stress models. They are treating Bitcoin like legitimate collateral, similar to real estate equities or bonds that back traditional lending. PNC Bank also entered the picture. They partnered with Coinbase to allow private banking clients to access Bitcoin trading directly through PNC's internal platform. These are families and institutions with significant resources. Once Bitcoin sits inside the same dashboard as their existing portfolios, the friction disappears. They no longer need a separate exchange account or a hardware wallet before allocating capital. Things get easier, which is what mass adoption needs in order to happen. So that's what's happening. And on the corporate side of things, we have Jack Mullers at Strike making his intentions clear. He wants Strike to become the largest holder of Bitcoin. That is a payments company stating publicly that stacking Bitcoin on their balance sheet is a core mission, as it should be, of course, as it should be for all of us. And they're not alone. Over 4 million Bitcoin now sit in global treasuries across ETFs and funds, public companies, governments, DeFi protocols, private companies, and custodians. Roughly 1/5 of the maximum supply is effectively out of circulation. Combine these developments. Regulators approve BTC as collateral, banks lend against it, private bank desks offer it as an integrated product, and treasuries worldwide lock away millions of coins. The financial system increasingly treats Bitcoin like digital gold that also functions as modern collateral. Now, the key question: how does this change the way the current bull market behaves compared to the ones people remember? For that, we bring in the supply squeeze and the analysts revising their targets ahead of 2026. On chain, we already discussed the 400,000 Bitcoin that left exchanges and the capitulation spike. Add the treasury layer, Bitcoin held inside ETF funds, corporate balance sheets, government reserves, and DeFi contracts. reduce the liquid supply even further. When new demand shows up, whether from banks, hedge funds, or high net worth clients, they compete for a much smaller pool of available coins than in past cycles. Bernstein put this into a clean framework. Their analysts argue that Bitcoin has moved beyond the old 4-year boom and bust rhythm and into a multi-year bull phase, which I have been saying in my videos for some time now. If you've been following my videos, you know this to be true. I've been saying as well that I believe Bitcoin will be in a bull phase here on out into the near future, just because the macro conditions have changed so much and global mass adoption has increased so much. I could not see it ending anytime soon. So it's very nice to have Bernstein say this as well and validate my case. Moving on, we see that Bernstein raised their targets to $150,000 for this next year, 2026, and around $200,000 the following year, 2027. Their logic aligns with everything we've covered: ETF flows, regulatory green lights, treasury accumulation, and Bitcoin's integration into the broader credit system. So here's the takeaway in simple terms. Past cycles relied on retail hype, blowups, and long hangovers. This one sits on something heavier: banks lending against Bitcoin, regulators approving Bitcoin as collateral, ETFs and treasuries locking away supply, AI and macro cycles injecting liquidity, and on-chain structure that still shows higher lows instead of a broken trend. So when you combine these forces, you get a bull market that resembles a multi-year campaign rather than a short-term sprint. It still produces sharp downturns. It still punishes leverage. But underneath, demand and integration expand every time price dips 20 or 30%. So let's bring it all together as we wrap up today's video. First, the candles look wild, but the larger structure still leans higher. Higher lows on the chart, capitulation signals firing, and fewer coins sitting on exchanges. Second, the macro backdrop leans risk on, with derivatives positioning, rate policy, and small caps all pointing towards more liquidity ahead. And third, Bitcoin now lives inside Wall Street's financial plumbing as collateral, on balance sheets, and inside private bank products, which turns it into a strategic asset for the system itself. So the real question is whether you treat this as just another local top or as one chapter in a much longer structural move driven by banks, regulators, AI liquidity, and on-chain supply. So if this breakdown helped you see the bigger picture, make sure you like the video, subscribe if you haven't already, and tap the notification bell so you never miss an update. And then, of course, let me know how you're thinking about this new collateral era for Bitcoin. Let me know if you have any specific questions I can address in upcoming videos. I absolutely love hearing from all of you, and I will do my very best to respond to everybody. If you're here, you're early in understanding how this bull run's rulebook has changed. I love you guys so much. Stay curious, stay prepared, stay engaged, and I'll see you guys in my next video tomorrow.